a tech advantage and cost savings without, a kind of new revenue stream is never going to get anywhere. So it's the same thing with a lot of the supply chain stuff kicked off then. And it was the same kind of thing. It all came down to like efficiency and cost savings.
Right.
And you would think, in technology that would move the needle, but it doesn't. It has to disrupt, or, look at what we saw once mobile came online. You actually have to be a business disruption or find some new product. And if you can't do that, then blockchain is basically dead in the water.
Hey everybody, welcome back to the Defiant podcast. I'm your host Vinny, here with Stuart Popejoy, the co-founder and CEO of Kadena. Before that, he led JP Morgan's Blockchain Center of Excellence, and he's also the author of the Pact Smart Contract Language. Thank you for being here, Stuart.
Thanks for having me.
So, Stuart, you've had a remarkable transition from traditional finance to blockchain innovation. Can you walk us through your career path and how you and Will Martino started Kadena after your time at JP Morgan?
Yeah, so I've been in technology since the 90s. My first job was at Apple Computer. I was out on the West Coast. And then I was doing various software engineering things there before it started. My original reason for coming to New York was the .com, not like financial. But there was a big need for programmers right when the .com 2.0, Web 2.0 was starting. So I actually pivoted into finance once I got to New York. I actually started off in web tech. That was just interesting because that was an interesting time in New York, Silicon Valley and all that stuff. So I think the reason why I say it is that I actually started in smaller companies in finance. I was originally at a place called Pink Sheets, which is an exchange. Started working on exchange tech, then working on algorithmic tech, and that's how I ended up at JP Morgan building algos. So that was a very tech-forward, pretty exciting place to work. But by the 2010s, it was starting to kind of cool down. And I started looking for new things, and that's how I ended up at the Blockchain Center of Excellence, because they were that was around 2014. They were just starting that up, and I was a director at that point. We had built this, we had basically revamped their entire algo system, and in doing so, I actually built a language for them for trading, and that actually influenced what happened with Pact, because one of the things about that language was that it had a weird feature, was it had to have no bugs, in the sense that it couldn't crash the trading system, it couldn't go out of control.
No pressure.
Yeah, because it was actually going to be non-technical people writing the trading scripts. But that was a big success, and got JP Morgan like 20 million in revenue year on year. That's how I made it to director. So that kind of gave me the leeway once I joined the research group to decide how we would be pursuing things. And that leads directly to how I hired Will, because one of the things we focused on was using the Haskell programming language, which has a place in finance, but is certainly not as well known. But at the time, and to a certain extent still now, it was a way to meet some of the smartest programmers out there, which is how I met Will, who is one of the smartest programmers out there. And Will made a big impact right as soon as he showed up, because he basically figured out how to turbocharge a private blockchain pilot. It was actually just a consensus, a student paper on how to do cryptographically secure classic consensus. And Will figured out how to get that up to, our first demo was at 5,000 transactions per second. And then the other part of that is that we actually incorporated an early version of the EVM into that. And that was the model around which we built the first JPM coin.
Right.
Was around a private, high throughput private blockchain. But at the same time, that's when JP Morgan was really, going big into blockchain. And as a result, we got to speak to everybody in the field at the time. So that while blockchain was certainly, experimental for the banks, blockchain itself, Bitcoin, Ethereum was already well underway by 2014. It hadn't launched yet. There was a bunch of interesting. Cosmos was just, I think, they didn't launch till a little later, but everybody was around, and all the technologies that would define crypto today were in their nascent form at that time. So even though business didn't really know what to do with it, and of course at the time Jamie Dimon was trashing Bitcoin and
Yes.
saying all that stuff, which is funny because, the thing to remember, because I used to get this question a lot, especially being at JP Morgan and then founding a company out of JP Morgan, like, what do you think of Jamie Dimon's statements? And the thing to realize is that there's one thing Jamie Dimon can't talk about, and that's stocks. He can't talk about the performance of an individual stock. So if he comes on and says something bad about a crypto, that's because he can.
Right.
So, it's kind of like, I wonder if he's, anyways, I'll just leave that at that. But the point being is that meanwhile, they were determined to be a leader in blockchain technology. And that's how that JPM Coin, JPM Coin was originally a more ambitious, it was going to be a commercial bank payments,
Right.
interbank payments platform, like full payments platform, and high throughput and all that. And that was what we were building for. And over time, it turned into what it is today, which is a little bit different than that. But anyways, the point being is that we got to talk to everybody. Vitalik came in, all, of course, the private blockchain people and, R3, everybody who was doing anything, was interested in talking to JP Morgan.
Of course.
So, yeah. So we really got to see what was out there. And that's really what led us to found, is because, well, one, we knew we did have a strictly superior private blockchain. And then we also knew that something needed to happen with smart contracts. And that was this idea that I had from my previous experience, that you can have a language that is inherently safer than not just Solidity, but any programming language, if you really focus it on what a blockchain is supposed to do. So
Right.
that's what we founded with. And that's our initial, we hit the ground running with a lot of paid POCs and things like that. That was the offering. It was basically something that has the throughput for real business and is also designed to be, these, even if it's private blockchain, it's still a blockchain, you still want it to be safe. You still, it's a private blockchain is still strangers, right? It's just not the public. So if they can hack the system, that kind of defeats the purpose.
Yeah, it really does. And so back in 2014, 2015, blockchain was still largely theoretical, I think, to a lot of these institutions. Were there any challenges that you came across when you were building like the beginnings of JP Morgan Coin and all the things that have led you here?
I mean, it was interesting to be at JP Morgan because that group had a pretty aggressive remit in terms of wanting to make progress in the space. Of course, we can indirectly take credit for Quorum because one of the things that kind of led us to found and lead JP Morgan was that they were uncomfortable publicly associating with open source tech.
Right.
And in fact, when we open sourced our private blockchain, JP Morgan said that we had to do it through Will. So it was actually on Will's personal GitHub. And he signed a contract with JP Morgan saying that, yes, this is entirely me and I will not say this is JP Morgan's code.
Wow.
But then 6 months later, they fired up, after we left, 6 months after we left, they fired up the JP Morgan GitHub. And that's what they did Quorum on, because I think, after we left, they were like, right, this isn't, JP Morgan should have gotten some credit for that,
I know, I'm surprised they would leave that on the table. And
yeah.
That doesn't make any sense. I know like banks can often be very, cagey about their information, but this seems like a great opportunity to showcase being a leader in the space.
Yeah, and I think it's probably one of those things that they find, like the lawyer, it was all about the lawyer, risk averse lawyers.
Isn't it always?
Right, sure. Wanting to protect JP Morgan, and once it became clear that they just needed, I guess, a little prodding to understand that, crypto is driven by open source software. If you want to be in blockchain, you want to be in crypto, you have to be open source. But other than that, it was a very exciting time at the time because every bank was involved, whether that was Goldman Sachs or whether that was Santander or whether that was UBS or all of the banks were, Bank of New York, Merrill Lynch, everybody was involved in a pilot. And, and those were also some of our paid work after we launched. Some of our revenue came from working for banks too. And really, I think it's actually that, and this is something that this is a question that's really only been, and we'll get to it later, but this is a question that's really only been answered recently, which was blockchain was a huge, presented a huge advance in terms of how collaborators could work together and trust each other,
Right.
basically. And they just weren't ready for that. But it also represented a way to cut, hundreds of millions in costs, because you have, like, the payment platform was going to take their existing system where they could only send money. This was just between JP Morgan geographical entities. They could only send money to each other 30 minutes out of each day. And we're going to take them to a 24-hour continuous system. It illustrates the age-old truth, which is that a tech advantage and cost savings without a kind of new revenue stream is never going to get anywhere. So it's the same thing with a lot of the supply chain stuff kicked off then. And it was the same kind of thing. It all came down to like efficiency and cost savings.
Right.
And you would think, in technology that would move the needle, but it doesn't. It has to disrupt, or, look at what we saw once mobile came online. You actually have to be a business disruption or find some new product. And if you can't do that, then blockchain was basically dead in the water. And indeed it was until RWAs came along. Private blockchain was more or less meaningless.
Wow, that's so interesting. Like, that cost saving is not enough to make it
Yeah.
happen. Like, the margins broaden, and that's still
Yeah.
like, there has to be money coming in, I guess. But
Well, one reason why is that you are trying to convince business heads
right.
to take a big risk, right? And they've heard it all before. When it's
I'm sure they
because
get
it's
pitched
still
all the
just
time,
tech.
right? Like,
Yeah, it's still just tech at the end of, to them, you're like, no, it's blockchain, really, it's different. They're like, uh-huh.
you're like,
Yeah.
changing the world, uh-huh.
Right, yeah, exactly. And, like, oh, and you're going to save me everything. And how long is this going to take? Like 2 years. So they basically have to write a blank check and hope it works out in 2 years.
Right.
This is a story they've heard many times before. So, in blockchain, they know what they're doing is different. But, that was another interesting thing, too, was that you did have people in the 2010s, the two worlds were not just separate, but they were hostile to each other. Private blockchain and public blockchain. You had people from, in the public blockchain world, saying all sorts of terrible things about private blockchain, but you had arguably worse things being said on the private blockchain side, saying they're all crooks and criminals or whatever. That stuff is just gone now. And so, so things have really changed from where they were in the 2010s, which this is what we founded to do. And so the fact that now that stuff is coming to public blockchain is just tremendously exciting, because in the end, our pivot to public blockchain in the late 2010s was really because that was where the innovation was happening. That's where things were moving forward.
Of course.
And so we said, well, private blockchain is basically frozen. So we're going to switch to public. And it was the right choice then. And we actually did think that at the time that public blockchain was going to make sense to institutions. So, but in business, it's not so great to be ahead of your time. Maybe if you're like a artist or something, but like.
Well, even then, right?
Even then, maybe not.
The market's not ready for you. You're kind of, you might as well not be good.
Right, yeah, exactly.
Same end point.
What if sending crypto felt more human? Pulse just launched Red Packets, a new way to gift tokens with meaning. It's gasless, gamified, and claimable inside group chats only. Think airdrops meet social cues on-chain. Backed by smart wallet tech and live across major L2s, Red Packets turned communities into microeconomies of gratitude and growth. No seed phrases, no friction, just connection with value. Check it out at pulse.social.
So let's talk about scalability, because I think that's one of Kadena's biggest selling points. A lot of Ethereum developers specifically are facing limitations with scalability. So can you explain why this is the case and how Kadena's chainweb provides a scalable plug-and-play alternative?
Yeah, so this was something we noticed right when we were, again, even when we were at JP Morgan. Although at that time we were probably more concerned with issues of safety than we were with scalability. But nobody was really talking about scaling on a public blockchain at the time. So this was something we more observed and then became more clear once we started figuring out how our technology made sense in a public blockchain context. And it's basically that, base layers like Ethereum, until, like 2021, the whole approach to scaling was going to be future tech, magical new blockchains that were just going to scale themselves. Ethereum was, famously going to go to a blockchain that had like 1,000 different chains on it, you know, and people are just pointing to the future and just saying, don't worry about what's going on blockchains now, because we're going to invent something that nobody knows what it looks like yet. And I think that's one of the things that Kadena has always been about, is like, how can we leverage the existing technology that we're very familiar with because of our backgrounds in trading tech? You know, how do we take stuff that scales, or, you know, concepts that work in scaling, and apply it to this area? Because, you know, again, in Ethereum, they wanted to be inventing new, you know, new scaling solutions from scratch, and that's just not how scaling works. Scaling works by using proven technology and going from there. Oh, and then for a while, there was the whole Ethereum killer narrative and the idea that everything was going to start going over bridges. But then bridges proved to be super unsafe. Like, bridges are not a solution for scaling. They are a solution for interop, but they're a dangerous solution. And you know, any of us who've been in this space for a while know that very well. We know about
We've heard the horror stories.
Yeah, and they're extremely expensive horror stories. The base layers were not designed to scale. Bridging didn't work. So then we got to layer 2, which is the current approach, and that has also kind of started hitting its limits as well, because it's just such a fragmented and complex system. I mean, it's really hard for developers. It gives very unpleasant choices to builders about how to scale their application that include things like running your own blockchain and having to have your own validators. And that makes sense for some things, but it doesn't make sense for a lot of dApps that are out there, you know, that actually have some idea of some kind of, you know, unique product or service they want to bring to their users that doesn't necessarily involve having validators and, you know, having a platform token and all that kind of stuff. So chainweb was basically based on the idea that some of the things that were around in early proof of work blockchain technology that were never pursued, such as there was a Bitcoin proposal called Betacoin, as well as another one that was called, I forgot what the other one was called, but they were both based on the same idea that comes from the original Satoshi paper, which is this idea of how you can safely move coins from one blockchain to another. It's similar to the way Litecoin originally worked, but then Litecoin moved to a different architecture. So we took those ideas because Will was able to formulate that if you had chains talk to each other via this thoroughly secure mechanism, but you don't have them talk to every chain in the network, you can come up with a way that you can grow a linked group of chains more or less indefinitely. And we call it braiding chains, because the chains kind of talk to each other in kind of a pattern. It's called a graph, not a graph like a chart graph, but a, you know, interconnected nodes like a DAG. But it's not a DAG. And it's a way that you can keep adding chains to the network. And so once we realized how this would work and how it worked with the Pact smart contract language, when we launched with this in 2020, it was the first of its kind, and it's still the only network of its kind, which is a truly parallel, horizontal, public blockchain scaling solution. We launched with 10 chains, and then a year later, we expanded to 20 chains. And it's just very interesting because it doesn't sacrifice security. It increases throughput. This is something that's just very strange in computer engineering in general. And theoretically, it has no upper limit. So that's what we launched with Pact. That's the essence of what chainweb is. There's more details to it. While chainweb is newish technology, although it's based on very central kind of concepts in Bitcoin, the idea that the way you scale is to be able to always add new resources, and usually kind of like indistinguishable resources. Like if you launch an application on Amazon, on AWS, and you know you have one server and it's getting overloaded, you put another server up and they're not different from each other. You need to be able to just use these things as resources and throw them at the problem. And that's what chainweb offers crypto.
It's like adding more juice.
Yeah, as it is needed.
Yeah, so the Kadena website claims that you could even scale to more than 50,000 chains, which definitely took me aback when I saw it. Could you elaborate on how this scalability works in practice and what impact it could have on real-world adoption?
Yeah, so the way it works in practice is the way chainweb works today, and then we're announcing a big expansion of what we're doing coming up soon. But today, Kadena is running 20 chains. and they can all talk to each other, with 100% security. It's actually interesting because it means our token actually exists on all the chains as a single token. You're not bridging the token to another chain. You actually burn it on one chain and mint it on the other.
Okay.
And it's all 100% secure. I mean, we've been running, it's not just a claim. We've been running since 2020, and there's never been a single problem with our bridge.
Right.
That was obviously a very important piece of tech to get right. And we would have found out probably if there was a problem with it, it'd be fixed by now. But so that's just luck. But so it's a very unique architecture in that regard. And because of the nature of proof of work, which is that the security that is offered by proof of work is basically a continuous amount that can be subdivided as much as you want. And miners, there's many, the optimal mining strategy for Kadena is to mine all chains. And it's more profitable for miners to simply randomize which chain they are mining on. As a result, we can add more chains, the miners are fine, and the way applications scale is by rolling out to as many chains as they need. So if it's the same thing, if your application is hitting bottlenecks, and indeed gas can go up on an individual Kadena chain, just like on Ethereum.
Right.
But you have an answer because you can immediately move over to another chain and you can scale your application over as many chains as you need. So there, again, theoretically, there's no upper limit on how many. It goes above 50,000. It goes up to. It's basically based on this solutions to this graph problem, and there's a solution that has 110,000 chains. I mean, it's infinite. So
wow.
So the way that works is there's no real reason to do it until we see the chain utilization hitting some kind of peak, and then at that point, we basically roll out a new version of the blockchain, and now it's got more chains. So it's not something that it isn't like AWS in that sense. It's not going to turn on based on demand, but it's going to be pretty easy to see when utilization gets to the point that we need to roll out more chains. At a certain point, you hit, I think, a limit of like how much bandwidth and, the other factors will come into play that once you get to something like 100,000 chains or something like that, but you never know. I mean, computers, networks get faster, computers get faster. Things that seemed inconceivable 15 years ago are just trivial now.
Right.
So, and that's generally the approach to scaling, right? Is to say, you don't worry about that upper bound because, you're going to have lots to do before you get there. Like when we get to 1,000 chains, for instance, that's going to be a tremendous amount of power for builders to utilize. Then, and it'll be a very interesting thing talking about all the tooling and all the stuff that is in place to help people once they're dealing with hundreds of chains. But, we're not there yet.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
So let's switch gears a little bit. Kadena has recently announced a $50 million grant program, which is very exciting. How is this fund structured, and can you share examples of some of the projects that have already benefited from it?
Yeah, so we're excited about this grants program. It has to do with some of the unique nature of our economic model and the fact that the flexibility that we have in terms of using the way the economics favor us being able to directly invest in projects. We've been around for a long time and we're still able to support projects as they come on chain. So I'm very proud of that. And that's something that's unique to Kadena. I mean, we already have, I believe it's the fairest token allocation of pretty much any major project in the sense of insiders versus, the vast majority of the coins come out of mining.
Right.
So it's a whole different scenario. And it also means that we didn't hand out all the tokens right when we launched, but instead those are still coming, they're still being released to the foundation so that we can continue to fund projects. That's the kind of economic structuring of it. The focus is on RWA as well as AI is another. We're interested in AI, and then stuff more in ecosystem development and infrastructure.
Right.
And a very exciting project that's coming on is Sushi Swap. But we have a bunch of other. I mean, unfortunately in literally a week we're going to be talking about I got a bunch of really exciting projects as we move ahead with our EVM plans and our testnet launch. But yeah, we've been able to secure some really. We just signed a deal with CurveBlock, who's a very tech forward RWA issuer. The grant program is something I'm very proud of and very excited about.
Yeah, and I think the fact that 50% of the funds are going to go specifically to RWAs is really exciting. Can you tell me more about what role you see RWAs playing in advancing blockchain technology?
Oh, it's already there, right? And it's what I was talking about before, in the sense that, I mean, I think BlackRock's BUIDL was kind of the watershed moment.
Yeah, everyone was like, BlackRock, are you
Yeah.
crazy? Like,
Yeah, Larry Fink turning into a degen. Nobody saw that coming.
No, it was not on the bingo card.
Yeah, it really wasn't. And it's funny because, we were working on a project very similar to that with a company called USCF. They're a big ETN issuer in the, leading up to our launch in 2020. Annalise was at various places, including ARCA, where she was working on all these things. So this wasn't a new idea. The idea of like taking like Spider or, S&P or any of these things and trying to like make a token, because the benefits are clear. I mean, it's a huge increase in the addressable market for these products, as opposed to just stocks, right? Well, one, it's international. Two, there's a 24-hour market. And then finally, once crypto really took off in 2021 or so, and started, the amount of money in crypto and the amount of transactions in crypto, started getting attention from the rest of the financial world. It also meant that you had all this money locked up in various protocols and various tokens.
Right.
And that was so that thing I was talking about before, because there are huge savings here. There, getting back to that topic, there are a lot of reasons why RWAs are incredible from like an efficiency. But the real reason why that they're actually happening is because there are markets, and in the case of BUIDL, they were able to immediately, it was a classic kind of trapped capital situation where you had, honestly, a lot of it was projects, like Kadena, where they have a lot of stuff either locked up in stable coins or locked up in their own protocol token. And, and it's all sitting on chain. And this gave them an ability to diversify on chain. So, so that was an immediate win. But then just what I was talking about before, international market, 24-hour access, these are the kind of things that actually like grow a market and make it into a bigger thing. And that's not to say it wasn't without risk. So, BlackRock and Franklin Templeton and some of the other more forward-looking institutions, they're benefiting from it, but, you have to hand it to them for also having the risk tolerance to really like move forward. The other thing, of course, I think that changed things was also the Bitcoin ETF, of course. And so there was just this way that all of a sudden these worlds that seemed completely incompatible with each other, all of a sudden now we're like, talking to each other every day. And, and that's just one kind of RWA. I mean, RWAs, you can tokenize real estate. It's stuff that we've been talking about forever that is inherent to smart contracts. This idea that you can really innovate in the product space. You can really bring out new instruments and products, and you don't have to wait. You can roll them out on a blockchain and nobody can stop you. So, and this was some of the things we were trying to say back in the 2010s too, is that this is a way to develop new products. This is a way to unlock new revenue streams. But, somebody had to take that plunge, and then the real missing piece was, and it needed to be on public blockchain. So that's where RWA has really changed the narrative, is that now you have every single institution figuring out how they're going to use use this resource that is public blockchains. And, so that war just came to an end. And now
we're friends.
Yeah, now we're friends. And, and that's the way it should be. And this is what we've been looking forward to at Kadena. So we're very committed to supporting projects. And the the opportunity is huge. It's something between like 2 and 30 trillion estimated.
Right.
So, again, that thing of like, is there money to be made? Oh yeah, there's so much money to be made here. And, and again, the main thing is that you just need to have systems that can really handle all the trading we're going to be doing.
So that is a great segue to my next question. Going back to Annalise Osborne, who you work with at Kadena, she's mentioned that the lack of infrastructure rather than the lack of institutional interest is what's creating this bottleneck for RWA adoption. What specific infrastructure gaps does Kadena aim to address with this new initiative, the $50 million grant program?
Well, I mean, a lot of the, when she talks about that, a lot of what because she's a very deep thinker about these things and is really broad awareness of the entire market. Because some of the gaps are like regulatory. There's
right.
And that's not, Kadena, we're not. That's not really our bailiwick. So infrastructure is more than just bits and bytes. There's a lot to. And there's a significant amount of work that has to happen in terms of like what you're making, because right now it's still the BlackRocks and these very tech forward, risk taking,
right?
So making it something that has broad applicability means you have to solve a lot of problems surrounding market access and all these kinds of things. So some of that for us is about working with great partners such as Onera. I mean, there are groups that are really trying to solve that middle piece problem, and we want to be part of that solution, but that's necessarily something that happens off chain. So that's a good example of where we're going to invest heavily in infrastructure projects in this area. And then of course, the final thing is that right now, a lot of everybody knows a lot of the trading that happens actually on blockchains happens on centralized exchanges, and there's a reason for that, because it's still difficult. It's still a difficult user experience a lot of times to actually be, to go onto Uniswap, to actually be a DGen and be trading directly on chain, even though those of us who are in the know that it's better and know that it's it's a truly free and decentralized system. So it's part of UX is gas prices and things like that.
Oh,
the fact
yes.
that it's going to cost you way more to trade on chain than it would at Coinbase. So that's where scalability, it's boring, but that's where scalability, is going to come back in. And that's where Kadena really, right from the start, we not just providing scalability, but providing the idea that you can also subsidize gas payments so that you never have to get into this whole horrible user experience problem where you're coming in to buy BUIDL, but now you have to own Ethereum. That's gone. I mean, most of your market just walks right away. Now, of course, then they just go to Coinbase and everything works out fine, or Kraken or wherever, and Binance, and it all works out for them there. But again, this is the kind of thing that this market is, my belief is that this market is not going to find its real potential until it can be on decentralized exchanges. And that's really where Kadena comes in terms of providing not just the raw scalability, but also the user experience.
Yeah, because I think something that a lot of degens kind of don't think about or respect necessarily is, most consumers are lazy.
Oh, yeah.
They're not interested in doing anything. That's part of why something like Stripe, is so popular, because you can be identified right away, and then it has your address and your credit card.
Right.
They're making online shopping, which has been around for decades, that much easier. And that's why
Right.
people are using it, not for any other reason. And so with blockchain, you have, all you have to do is get the wallet and write down your seed phrase and then do this and then bridge. And it's you lost me at get a wallet. I'm gone already. Well, not me, but but most people. And so I think do you feel like there is a shift in both the perspective of Kadena and maybe in some of your peers, in that it's better to meet consumers where they are rather than to maybe shame them into thinking you should want privacy, you should want decentralized, you should, I should want to just chill in bed and not worry about any of this. Right?
And laziness is one aspect of it, in the sense you have to make things easier, but it's also, it's just not important to people, right? In the sense that the things that, if you're a builder and you're a blockchain enthusiast, those things just aren't going to be important to the mass market, right? It's kind of similar in the sense that you have to give them something that they actually want, and then you have to get everything out of the way.
Yes.
That makes it confusing for them, because why? Because that's just a terrible idea in general, is to make something hard, and it does, and it does require staring hard at some of the some of the beliefs people have about like, about, I think there is this kind of, people like, sometimes they like complex systems because it makes them feel smart once they master them.
I was just thinking that.
You know what I mean?
I definitely sometimes feel that way. I'm
Yeah,
like, yeah, it's cool. I'm smart.
Right. Yeah. I mean, it creates a barrier, and then you hop over that barrier, and then you're on the inside, and everyone else is on the outside. But,
Type A personalities. However, we're not all that. So-
right.
And I want my mom getting on chain. I want grandpa getting on chain. Like I don't want it to feel like it's just something that a specific demographic, niche of a demographic gets into, when it's actually something that's going to be better the more people that are on it, and I think better for society in a lot of ways. Which
means it needs to be safer. It needs to be like this whole thing of like you lose a piece of paper and then you lose all your money forever. That has to go away. All of these things have to be made so that it's dead simple. I mean, it's still there is one thing that that we do want people to change. We want people to custody their own assets. That is doable. And especially with things like, all you really need these days to do that securely is have 2 devices, right? If you have it, that you have your phone and your laptop or something like that.
And I think most people are there.
Yeah, if you have something as simple as 2 devices, then you could be using, all the passkey technology and all those kinds of things. There is no, and we have a product called SpireKey that does just that. That makes it. One of the things about Kadena, and this is something that will come a little later, is that eventually people will realize, once this happens, people will be able to do things like be able to like share authorization like with their family, and through a process called multisig.
Right.
And that's something that you can do with with Safe and Gnosis, but that's Safe Hack, right? That showed you what happens when it's not on the chain. If it's not an integral technology to what's on chain, then you're gonna, you're
then it
putting
ain't so safe.
It is not that. Yes, indeed. And so one of the things about Pact, and we're really working hard with like Pectra and some of the upcoming EVM changes to bring this stuff. One of the things about Pact is, in addition to being able to develop the first parallel multi-chain protocol for tokens, is also that Pact from the start had built-in multisig. So it's effortless to be able to do something like that. Like, that you can do that for security. You can make it that 2 people have to sign, but you can also do it to make it that like you or somebody else could sign, or all these kinds of like, you have real flexibility in custody. And that's the part that I think is, it's always going to be lagging behind everything else, because that is something that like only, most people are just fine having all their stuff on their phone. And if they lose their phone, they lose everything, right? So that part isn't better or worse.
I wish I were more chill about that. I'm like,
no, and that's good, right? And that's, so when we've really won this battle is when, basically grandma has a multi-sig with, uncle or whatever, and they, and people can work together, to secure their assets and even share their assets. I mean, that's the real future of decentralization for me.
And I feel like that's something that people would be more comfortable with, especially if they don't feel technologically savvy. Because there are plenty of people in this world who, maybe like older Gen X or boomers who are like, well, I don't have a computer and I'm proud of it, or they don't want to use a smartphone or whatever. And I think like if you can bring them in saying, well, this is actually something to collaborate with your grandkids, or like you can actually sell it to them, I think, in a cool way that doesn't make them feel scared. Because a lot of people can feel scared by new technology, and they're actually afraid of not understanding what it is and doing the wrong thing, right? So the multi-sig solution, to me, actually makes it a lot more collaborative, and human beings are collaborative by nature.
Right. Exactly. Yeah. So I think but getting back to RWA, that's also boomers, and I forget what the younger ones and that, what do they call alpha?
Gen X. Oh, the Gen Alphas. Yes, the kids.
No, not boomers, Zoomers. Sorry. Okay. Zoomers and alpha, like they're tech native.
Right.
And I do that all the time. I'm Gen X, and then I refer to Zoomers as Gen X, and then it's like, no. And then
too many letters.
Yeah, it's just too many. I get it wrong all the time. They're tech native, they're mobile native, and they're also used to, they're pretty sophisticated in terms of like what they're used to in terms of, accessing resources and stuff like that. So crypto's got its work cut out for it there. But the other thing is that they have a kind of inherent understanding of, some of the flexibility that you get when you're able to like deal with financial assets in the crypto space. So I actually think there is just straight up demand there. And, we see this, right? We see it with all the brokerages starting to offer crypto and stuff like that.
Yeah.
So I think the market is growing, by itself to a certain extent through centralized offerings. So moving that to the decentralized space is where RWA is really going to explode.
Yeah, absolutely. So to begin wrapping up, I'd love to just get a couple more thoughts on your expertise on like thinking about stable coins, thinking about, banks and blockchain. So many banks are trying to build on blockchain, as you well know and have been a part of, but some are struggling, I think, with like scaling and implementation. What do you think that traditional financial institutions often get wrong when it comes to incorporating blockchain technology?
Yeah, I mean, for a while, everything. And
they need to listen to those advocates that are that are inside telling them.
I mean, I actually think it's not. This is one. I mean, at one point I might have thought it was more the bank's fault, but I actually think that this is something where there needs to be a relentless focus on making sure products have a market.
Yeah.
Because in fact, that stuff is going pretty well. I mean, like, some of the partners we're working with, the demand is there.
Right.
And there's so many assets that can come out. So I don't, at this point, I think it's projects like Kadena, but it's also projects like Onera and all the partners we're working with, continuing with that work and making it that because you need to have specialists in this. You need to have people who are real experts who are then bringing other people in, and that's how this is all going to get solved. Because banks are banks. Like, yes, they're. I think it was Jamie Dimon who said, JP Morgan's a technology company. Like, banks pretend to be technology companies, but they're not. They're financial companies. They shouldn't.
And they're good at what they do.
And they're good at what they do. So like, it's really about like it's about the people building the glue and all these different pieces. Because again, the opportunity is totally there. So I don't. I guess the main thing that they need to have. It's more like what the projects need to stay the course, because banks have to move slowly. I mean, that's the main thing, is that they're very constrained regulatorily. Of course, we have things like, we have stablecoin legislation coming through. Things are moving forward. Yeah. So there's a lot of really exciting things happening that will make it easier for them to get involved. So, right now, I think getting those things out of the way are the most important. So, so they get a pass this time.
Well, it's like we build the railroad and the trains. We're like, come on board whenever you're ready.
Right, exactly.
We're all going to the same place.
Yeah, it's not the bank's fault if the tracks aren't there. So.
No, exactly. And, this regulation, banks, they're all going to take their time. And it's not as fast as maybe some of us would like, but we'll all get there. And then finally, so I know there's a big announcement in the works for early next week. This podcast will be airing after that announcement. Is there anything that you can tell us that you're, excited about for Kadena?
Well, we already announced that we're doing chainweb EVM, and this is a big move. It matters to the RWA discussion too, because it's really clear that EVM is an important standard, and that's something we want to adopt. We don't want to stand in people's way. We want to go where they are and go where the builders are, and that's why we're bringing chainweb technology to EVM. Right. Is even though EVM is an imperfect technology in itself, there's no reason why it shouldn't benefit from this kind of scaling. So the main thing I think that is really exciting is that we're announcing, in a week we'll have announced testnet. And that's really exciting because of all the partners we're bringing on for testnet. Right. This is something where ecosystems don't build themselves, and this is where we've been legging in with our grant program. And that's the part I can't talk about yet. But the partners that we're working with are truly exciting. They get the potential of the system, and it's really going to be a full slate of, it's going to be a mature EVM ecosystem right from the jump. So super excited about that.
Well, I love it's really tied together beautifully by what you said in the very beginning of, we're not reinventing the wheel. We're just building on the concepts and the stuff that's already there and making it stronger. So it feels very in line with that. Well, Stuart, thank you so much for coming in. Where can our audience find you?
Well, we're at kadena.io, but of course, we're also on Twitter if you want to get more, and we're on Telegram. And then, we have a Discord for even if you want to go deeper, and especially builders, I think, but, all the usual places, and you can also find out more about our grants program on our website. And and if you have an idea and you want to come build on Kadena, we'd like to talk to you.
And this is on a rolling basis, right? There's no deadline?
No deadline.
Okay, devs, get in on this. Sounds great. Thank you so much. And we'll have to have you back in a few months to talk about some of these secrets as they go live.
Okay, great. I look forward to that.
Thank you.